We'll talk about mortgage relief, the forbearance that is available to some individuals. We'll talk about student loan forbearance, and then just a quick word about income taxes before we move into the general financial management information. So first, these economic impact payments. You may have heard them referred to as rebates. You may have heard them referred to as stimulus payments because that's what they were called back in 2008, 2009. And you probably know the basics of this, that the maximum amount that you could receive from these was $1,200 for the taxpayer and another $1,200 for the spouse if they were filing jointly, plus $500 for any dependent child age 16 or younger. Those are the maximum amounts. But not everybody qualifies. One of the gaps, and I have really heard no explanation for this, whether it was intentional or unintentional, but dependent children age 17 or older are not included here. There is no $500 payment for them. And even if they file taxes themselves, let's say you've got a 20 or 21-year-old child who, while they're a college student, does have earned income and they are filing taxes, but they're also checking the box that says, I'm claimed as a dependent on someone else's return. Even though they're filing taxes, they are still not eligible for the $1,200. And because they're age 17 or older, you are not able to get $500 for them either. Another group that doesn't qualify is anyone who does not have a Social Security number. You also have to qualify based on income. And so here with the chart, you see the four main filing statuses. Single and married filing separately, in this case, are treated the same way. The first column of numbers is the adjusted gross income amount that if your income is at or below that number, you would get the full payment. The second column is the income at which your payment will probably phase out, meaning that you would get none if you're at that number or higher. If you have dependent children, though, that you are getting payments for, it may be that the maximum income amount will be higher for you. There has been some debate about whether these numbers were across the board maximums or if they were only the maximum number for someone who was receiving a payment just for the taxpayer and spouse. The big questions that have come up around these payments are how you'll get your payment. The good news is that more than 90,000 payments have already been distributed, but not everyone has received them. And so to try to deal with some of the complexity here, I've put together a flow chart. You'll probably be able to tell when you see this. I am not an expert at creating flow charts. I understand logic very well, but the design of these things is a new skill for me. I hope this will be helpful for you. So we're going to take a couple of scenarios that you might find yourself in and use the flow chart to figure out, will I get a payment and how will I get it? So let me first take someone who has not yet filed their 2019 taxes because they didn't have to, right? We were given a buy until July 15th for that. So we haven't filed 2019. That's the first question on here. We're saying, no, I didn't. Well, then you have to ask the question, did you file 2018 taxes? Hopefully the answer is yes, if your income was high enough that you were required to file. And if you do answer yes there, then the next question is, was there a refund that was direct deposited? If there was, if the answer to that is yes, then you should have received your payment through direct deposit to that same account. But if the answer to was a refund direct deposited, if the answer is no, because there was either no direct deposit or there was simply no refund, in that case, you're someone who will receive a paper check unless you're able to take some other action that I'll talk about shortly. Let me use one other scenario here because there are a number of folks who don't file taxes because they're not required to. Often these are our elders who are perhaps receiving only Social Security and their income is not high enough for them to be required to file. Same thing with people who are receiving veterans benefits, SSI, or railroad retirement benefits. So let me take my mother-in-law who falls in this category and we'll go through the flow chart for her. First question, did you file 2019 taxes? No. Did you file 2018 taxes? No. Were you required to file? No. Do you receive Social Security, SSI, veterans, or railroad retirement benefits? Well, yes, actually, I get Social Security. So then we move to the almost final question, is your benefit direct deposited? And in my mother-in-law's case, the answer is yes. So she should be getting her payment by direct deposit. And people who are Social Security recipients, and this is the route by which they're going to receive their payments, should be receiving those payments this week. They should have started on Monday or Tuesday of this week, and I believe they anticipate for those to be completed shortly. Now, if she did not have her Social Security benefit direct deposited, in that case, she would, like people who did not have direct deposit for a tax refund, she would also be receiving a check. You'll notice down in the lower left-hand corner, there's a box about using the non-filers enter your payment information here. For someone who did not file taxes, but is not in this Social Security, SSI, veterans, and railroad retirement benefits category, the answer to that being no, their income is low enough they weren't required to file, but they aren't receiving any of those benefits where the government would have their information, they need to use this non-filers enter your payment information here tool in order to get their payment at all. Now, here, I'm giving you 3 websites. These I did not shorten. I apologize for that, but they're at least words, so they're not too hard to type in. The first one is the general Q&A for any questions about economic impact payments. It's very complete. You may well find an answer here if you're uncertain why you didn't receive one, why the amount was what it was, and so forth. One of the things you're going to also be asking questions about is there are 2 tools. One is the one for non-filers. The other is a tool called Get My Payment. It's a way to find out what the status is of your payment, whether it has already been processed. And if you need to provide additional information, it's all about your bank account and so forth. It's also a tool to do that. So the second link here will help you figure out which of these tools you might need to use and what they do. And then finally, the third link is where you'll find the link directly to both of those tools if you need to use them. And again, this should be in your handout. If it's not, again, all of these you'll be able to find on my webpage. Now, the flow chart didn't address every situation. I kind of ran out of room, so let's talk about a couple of those. What if the bank account information that the IRS has is not current, and perhaps your mailing address is not current? If you have already filed your 2019 taxes, as of right now, they're saying that you actually cannot change that. You'll probably have to wait for the check to be refused by a bank or for it to be returned. If you didn't have a forwarding address on file, that's not good news. But if you haven't yet filed 2019 taxes, the best way to give the IRS your current bank information and your mailing address information is to ASAP file your 2019 taxes and file them electronically, not by paper. Right now, paper returns are either not being processed or processed very slowly. And so filing electronically is going to be your best bet here. Now, what if the IRS doesn't have your bank account information, either because you didn't receive a refund or because you didn't use direct deposit? And just to be clear, even if you owed money to the IRS and you gave them your bank information to use to draw the payment from, they cannot use that bank information to make a deposit to. And so in this case, you would need to provide your bank information to the IRS, and you should be able to do that using the Get My Payment tool. You may have heard that this has been fairly buggy. There have been problems with it, but they made some major upgrades over the last weekend. And many people who had been unable to either provide their bank account information or to find out the status of their payment have now been able to get that kind of information and provide the information needed by the IRS to send them their payment by direct deposit as opposed to waiting for a check. And finally, back to those Social Security recipients, SSI, veterans, railroad benefits. who don't file taxes, but who are going to get their $1,200 payment automatically, whether it's direct deposit or by check. What if they have a spouse or they have a dependent child, and they should also be getting a payment for them? That requires an additional step. They should use the non-filers enter payment information here button. At least they should try that. But we're in a transition point right now. The IRS last week gave very short notice that in order for these individuals to receive, for Social Security recipients to receive their additional money, they'll get their $1,200 anyway, but if they were entitled to additional dollars, that they had to file by Wednesday of last week on this link. And if they miss that, the current information says the only way they'll be able to get the $500 for a dependent or $1,200 for a spouse will be to file their taxes next year, to file their 2020 taxes in early 2021 next year in order to get those dollars. There is a new deadline for SSI recipients, veterans, and railroad benefits. They have until May 5th. This was just announced like within the last 48 hours, that they have until May 5th to go to the same link to the non-filers enter payment information here and provide their information so that they can get the additional dollars that they would be entitled to and hopefully get it by direct deposit as well. But the bottom line is, if all else fails, for some reason, you were not able to get the payment that you should have received this year, you will be able to get it when you file your 2020 taxes next year. You will receive it then. That's not as good as having it today, but at least it's better than not being able to get it at all. The reason that you would be able to get it when you file taxes next year is because technically these payments are in advance against a one-time credit that will be appearing on the 2020 tax return. This is something that you do not have to pay back. It is also not taxable income. And when you file your taxes next year, let's say that this year you didn't have a child and you got $1,200. But you have a child during this year, 2020, and when you file your taxes next year, lo and behold, there's this new dependent on your return who entitles you to an extra $500 payment. In that case, you will get those dollars next year after you file your taxes. They are telling us that when you file your 2020 taxes, let's say that because of income changes or what have you, you qualify for less money based on your 2020 return. Doesn't matter. You're being given payments now based on either your 2018 or your 2019 taxes. And if next year it turns out that you should have received less, they will not take that money back. The one thing we're not quite clear on yet is what happens if a payment is distributed erroneously. And the main example here is payments being sent to deceased individuals. We don't yet have clarification on exactly how that's going to be resolved. Secretary Mnuchin is saying that he wants those payments returned, but there are questions about the legality of that, the way the CARES Act was written. So on that question, you'll have to stay tuned. Here's our last piece of information about the economic impact payments, and that is, can creditors take your payment? There was a flurry of news articles about 2 weeks ago on this. Here's the situation. In the law, the federal government only prohibited themselves from taking your payment. If you would normally not get a tax refund because you have defaulted student loans or you owe income taxes, they have waived the federal government's right to take your payment based on those two reasons. But the one reason that the federal government would withhold your payment is if you are behind on child support payments. Now, that's the rule that applies to federal government's claims as far as money you owe them. It's a separate question whether the bank where your money may be deposited could take the dollars or not. Illinois does not have a state law regarding this, and so you're really reliant on the individual bank's policy. So if your deposit went to a bank where you were actually overdrawn, you owed for bounce checks and that sort of thing, It will actually be up to the individual bank whether or not they will take part of your payment to cover that, or perhaps to cover a loan you have with them that you are behind on payments. So this is, unfortunately, this has affected some individuals. There's not a whole lot to be done about it. Now, if there is a question you had about economic impact payments that I did not cover, please take advantage of the chat to post your question there, and we will cover as many of those at the end as we can. But for right now, I'm going to move on and talk about unemployment insurance. And as I said earlier, here the focus is going to be on the expanded benefits that are being paid for by the federal government as part of the CARES Act. So the first expansion is that there will be no waiting period, that you'll be able to get unemployment benefits from the day that you were unemployed, rather than having to wait a week without pay. The second way that it was expanded is called the Pandemic Unemployment Compensation Program, which increases the amount of unemployment insurance you get by $600 per week. They're trying to minimize the economic impact on individuals who have lost their jobs. This particular program will end on July 31st. Illinois had this up and running already the week of April 5th. And so if you've already applied or are already receiving unemployment benefits from the state of Illinois, you should also be receiving this additional $600 a week as part of those payments. Another way that the benefits have been expanded is known as the Pandemic Emergency Unemployment Compensation. This expands the length of time over which you can receive benefits. Typically, you can only receive unemployment compensation for 26 weeks. This gives you an additional 13 weeks. And this program will go through the end of 2020 all the way up to December 26th of this year. And so if before that date you exhaust 26 weeks of unemployment insurance, you will be able to use as much of those additional 13 weeks as you have before the end of December 2020. Illinois has been struggling a little bit to get this in place. It was supposed to be implemented last week. It's a little unclear whether that's actually happened, but the good news is that, let's say while you're waiting for this to get implemented, your 26 weeks runs out and you have a couple of weeks where you didn't receive any unemployment. Once they have this up and running, you would be able to receive benefits retroactive to when your 26 weeks had run out. One more way that benefits have been expanded is you might be able to receive partial benefits if you were moved from full-time work to part-time. And this is intended for situations where an employer, rather than laying people off, transitioned full-time workers to part-time workers so that everybody could still have an income. That's a situation where you would be able to now claim partial unemployment benefits because you were moved from full-time to part-time work. And you might hear this referred to as short-time or work sharing when it's described. Now, this is the most groundbreaking expansion that is being applied to unemployment insurance. It's referred to as the Pandemic Unemployment Assistance Program. You'll notice these all sound very similar, but I've put the technical titles here, so if you are talking with someone about these, you will know what the terminology is. The assistance program here is intended for those who would not normally be eligible for unemployment insurance or who may have exhausted their state benefits. And typically, self-employed individuals are not covered by unemployment, but they can be covered under this new provision. This may also cover part-time workers and workers who have such a short work history that they wouldn't normally qualify for unemployment. To claim under this provision, you might be fully unemployed, or you might be working part-time and be partially unemployed. Or you might fall into a completely separate category where you are unable and unavailable to work, and normally that's a disqualification from unemployment. Unemployment usually says you must be able to work and available, but the exception here is being made if you are unable and unavailable strictly because of direct impacts of COVID-19. For example, if you were diagnosed you tested positive for COVID-19, or someone in your household who depends on you for their care was diagnosed as positive with COVID-19. And there are 4 or 5 other examples of how you might have been directly impacted by COVID-19, and that in itself is preventing you from being able to work. And I've given you a link here to a nonprofit organization that has a very clear and understandable list of what these COVID-19 impacts are, and I welcome you to check that out. If you qualify under this, you could receive retroactive benefits as far back as January 27th of this year, and this program also will go through the end of December. Now, here in Illinois, this program is not up and running yet. Apparently, they are targeting perhaps the end of next week or the beginning of next. This is as I said, this is the most groundbreaking thing that the CARES Act did in terms of expanding unemployment insurance. And because it doesn't fit in the normal boxes, states are having a more difficult time setting up the process for you to get this. What I've been told by a couple of sources that I typically rely on is, until this is set up, what you may need to do is go ahead and apply for regular unemployment and actually expect to get turned down. That will likely be the first step that you will need to take before you can reapply under this expansion when it becomes available. And also, you may want to just be checking the Illinois Department of Economic Security website to see when this program is up and running. Not only have people had difficulty applying for that particular program yet, but in the early days, meaning just 3 weeks ago, really. But when unemployment first started happening, when the stay-at-home rules were put in place for Illinois, the state unemployment system was simply overwhelmed with unemployment applications. People were spending hours, days trying to get into the system to file. They have worked hard at trying to upgrade the platform that houses this unemployment application system. Supposedly things are going much better, but if you do have difficulty, do keep trying. And the good news is that if you were delayed filing because you simply could not access the system, when you file, your benefits will be backdated to the date that you became unemployed, not the date that you filed, but the date that you became unemployed. And if you have questions about how any of this is working in the state of Illinois, Illinois Department of Economic Security has a very good FAQ. It's a PDF file that for the first 2 or 3 pages answers basic questions about regular unemployment, and then goes on to add questions about the special circumstances now with COVID-19. And this was another one of those URLs that's like, 69 or 189 characters. I don't know how long it was. And so I put this into bit.ly so that you would have a shorter, more user-friendly URL to be able to type in. So again, here we're finishing with what I can tell you about unemployment. If you have additional questions on this, please, again, use the chat window to put those in, and Patty will be reviewing those and feeding me questions at the end so we can work through those in a fairly efficient manner. Now to mortgage relief. With mortgage relief, what's being offered is forbearance, meaning that you may be able to skip payments. You must request it, though. It is not automatic, and it's not available to everyone. And you may not even want to take advantage. There are situations where you might not want to take advantage, even if you are eligible. So first, how does this work? Again, I have a link here for you that will take you to some of the details on it, but this is specifically for mortgages that are either federally owned or federally backed. The first question you may have to answer is, who owns my mortgage? And so this link will take you to a tool that I believe it's on the Consumer Financial Protection Bureau's webpage that will help you figure out who owns your mortgage, so that you can see if it's owned or backed by one of the 7 or 8 federal agencies that are covered here. And if you are in a eligible mortgage. The next question is, you're going to have to document that you are experiencing financial hardship due to the pandemic. Whether you lost your job, whether your hours were cut, there may be other ways in which you are experiencing financial hardship because of COVID-19. You will need to document that, but you shouldn't be asked for any other documentation. For example, your bank should not, or your lender should not be asking you, should not be checking your credit report as a part of deciding whether you're eligible for this. That is not a criterion in this case. What you may get is the ability to either pause your payments entirely or to pay reduced payments based on the degree of financial hardship that you're experiencing. And this pause or reduction can last for up to 180 days. And if you are still experiencing hardship once the 180 days is coming to an end, you could request an extension that could last again up to another 180 days. The terms of this, as dictated by the federal laws that were passed, is that your lender cannot add on any additional interest. They cannot add any fees or penalties because you are taking this forbearance. Now, kind of a side note here, as I mentioned, these are only for federally backed or federally owned mortgages. What if you have a privately held mortgage? And it's about 50-50, apparently, here in the United States, although maybe the majority that are federally backed or owned, but we do have a significant number of privately held mortgages. Yours may be one. How do you know whether anything is available to you? You're going to need to contact your bank or your loan servicer and find out, are they making any accommodations? And exactly how do those accommodations work? Remember, these are going to be determined by the individual lender or bank, not governed by anything in the federal law that applied to the federal mortgages. Before you call your own bank or loan servicer, you might want to check this list on this slide that the link will take you to. Forbes compiled a really extensive list of individual banks across the country and the types of accommodations that they were providing. And this list includes actually not only accommodations that they may be making regarding mortgages, but also other bank products. Maybe you have a personal loan. Maybe it's something as simple as that they're waiving ATM fees if you use an ATM at a bank other than theirs, because they're recognizing that right now people should not be out traveling to go to an ATM. So you may want to check that first and then contact your bank or loan servicer to see what they're offering. Now, whether it's through the federal program or if you have a privately held one and they are offering to do forbearance, there are some things you need to think about. First of all, if you can actually afford to continue paying your mortgage, both Consumer Reports and the Consumer Financial Protection Bureau both are on record saying, if you can pay, keep paying. There are some potential issues when your forbearance ends that I will be talking about. Also, perhaps you've requested a forbearance, but then you are able to go back to work, or the financial hardship that you were experiencing turns out to be less formidable than you expected. And again, Consumer Reports and the Consumer Financial Protection Bureau both recommend, if you become able to pay your mortgage again, then stop the forbearance and start making your payments again. But on the front end, before you agree to the forbearance, two things to find out. The smaller issue first, the big issue second. Smaller issue is, if you have a mortgage where your payments are not only principal and interest, but your payments also include payments towards your property tax and property insurance that's placed into escrow to pay those bills on your behalf, ask how those are going to be handled during the forbearance. Is the lender going to front that money for you into the escrow account? Will your property taxes continue to be paid? Will your homeowner's insurance continue to be paid? If not, how will you be able to make arrangements to take care of that? Because the last thing you want to happen is unpaid property taxes or unpaid property insurance. If your property insurance defaults, if you lose the insurance but for non-payment, your lender actually has the right to do what's called force placing insurance. They will buy insurance on your behalf, and I can tell you that they will not shop around for the best deal. So you want to make sure before you start a forbearance how taxes and insurance are going to be handled, and make sure that you're not going to be harmed by how those are handled. And then the really big question: how are these missed or reduced payments going to be made up? The worst answer is there's going to be a balloon payment when your forbearance ends. Let's just take an example here. Let's say you get a forbearance for 6 months. Your mortgage payments are $1,000 a month. And let's say that you didn't get a forbearance for the full amount, but they've reduced your payments to $500. So for 6 months, you're paying $500. You should have normally paid $1,000. 6 months times 500, the amount that you're not paying, is $3,000. It's possible that your lender is going to say, when the forbearance ends, you owe us $3,000, the full amount of the payments for which you received forbearance, and you're going to owe it on the first due date of your first payment after forbearance. If you couldn't make the payments during the 6 months, how are you going to come up with that cash at the end? To me, this puts you at very high risk of foreclosure. The better answer is that the amounts that you did not pay are simply going to be added to the end of the mortgage. And so in the example I just gave you, where you were given a half, 50% forbearance for 6 months, that in that case, they would say, well, we're just going to add on 3 payments to the end of your mortgage, 3 full payments, which adds up to the same amount of the forbearance that you received. That would be a good answer. That means that if you can pay extra as times get better, you'll be able to do that, but you're under no obligation to ever pay any more than what your loan amount was when you went into forbearance. And a middle ground kind of an answer would be that they're going to ask you to make larger payments over some period of time to make up for it. So again, in our example where you had $3,000 over the course of the 6 months forbearance that you didn't pay, maybe they're going to take that $3,000 and maybe they're going to spread it over your payments for the next 2 years. And I haven't done the math on that. I'm not sure what that comes out to be, but a couple $100 a month, I believe. That you would have to add to your monthly payment until you made up for the payments when we're in forbearance. Now, that's going to be a burden, but not nearly as much of a burden as trying to come up with a balloon payment. So here ends the section on mortgage forbearance. If you have questions about that, again, please feel free to put it in the chat, and we'll come back to that at the end. And now, student loan relief. If there is a place where Congress outdid themselves in looking after people who could have found themselves in really horrible circumstances right now, this is one of them. We already know from the news that we've been hearing now for years about the amount of burden that people have from the student loans they took out to get their education. The rules I'm going to go through here show me that not only did they recognize that individuals may have a lot of difficulty making their payments right now, but that by not making payments, they could have been deprived of other kinds of relief that they were working toward, and they've taken care of those problems. So first, for any questions that you need after tonight about this student loan relief or anything else about federal student loans, studentaid.gov is always your go-to place. And for things related to the coronavirus, you want to go to studentaid.gov announcements-events/coronavirus. They've got an expansive FAQ here where you should be able to find your situation and understand exactly how you would be impacted here and what opportunities there are for you. Loans that are eligible for forbearance under the provisions of the CARES Act that was passed on March 27th. First of all, this only covers federal loans. I'll talk in a moment about private loans. And it covers most, but not all, federal loans. Now, it doesn't matter whether your loan is defaulted or not. That's not the issue. The issue is whether your loan is owned by and paid to the federal government. That means that virtually all direct loans are going to qualify here. But there are some FFEL loans, the Family Financial Education loans, that you don't pay to the federal government, that they are owned by a commercial lender. Those are not covered. Similarly with the Perkins loans, most Perkins loans are going to be covered, but not if they're actually owned by the educational institution that you attended and not by the federal government. So this is one of the first things that you'll have to figure out if you do have a FFEL loan or a Perkins loan, whether you're covered or not. If it's a direct loan, you're covered, no problem. This program started on March 13th, and it went into effect automatically. You did not need to take any steps to make this happen yourself. This will go through September 30th, and your full payment would be put into forbearance, meaning that they're simply suspended. You do not have to make any payments. During this time, there will also be zero interest accumulating. So you're not going to end up with a higher balance after the fact because you took the forbearance. Now, here's some very important information, because if you are someone who is working toward public service loan forgiveness, which takes 10 years of on-time payments, working full-time for either a government entity or certain nonprofits, you might be worried about losing payments toward that. If you have suspended payments during this time and you were at the time of the suspension working toward public service loan forgiveness, your payments will count as if you had paid them yourself. One tip here, if that's your situation, if you haven't yet, get your employment, the work that you were doing before the forbearance went into place, get that certified through studentaid.gov to show that your work qualified toward public service loan forgiveness, so that the payments that you would have been making during these 6 months will still count. Similarly, if you are in an income-driven payment plan, as opposed to a standard 10-year repayment plan that is based on the balance that you owe. Income-driven repayment plans are those that base your payment on your income rather than the balance of the loan. And you often end up with a balance owed when the 20-year period of the loan comes to an end, or the 25-year period, depending on exactly which type of income-driven plan you're in. These payments during these 6 months will also count toward your 20-year or 25 years of payments. And so you will still be able to receive forgiveness at the end of the time period that you were expecting. And finally, perhaps you had a loan that was in default and you had asked to rehabilitate that loan, meaning to get it back on track to be counted as being current and payments being received as planned. Rehabilitation typically requires making a certain number of on-time payments over a certain number of months. Well, these suspended payments could interfere with that, but the law says these payments, even though you yourself are not making them, they are still going to count toward that rehabilitation. And so these 3 things are where I feel like Congress really was looking around and saying, if we do this forbearance, we have to make sure that it doesn't come back around and bite these borrowers in some backdoor way. And so they've tried to take care of those potential issues for you. A couple of tips on this. If you have lost your job and you are making payments on a student loan, first, if you are already in an income-driven plan, you should request a recalculation of the payment that you're responsible for. If your income has dropped, that will reduce the amount of payment that you would be required to make, and you can go ahead and ask for that recalculation now, whether or not this is your anniversary date when it would normally be done. Also, if you have been in a standard repayment plan, maybe you were just barely being able to handle that, and now your income has dropped, it may be a time to look into an income-driven repayment plan if you expect that this lower income is going to last for quite a while for you especially. And if you have one of those FFEL loans or Perkins loans that are not eligible for this, you can make them eligible by consolidating them into a new federal direct loan. I have read supposition, well, one of this is supposition, the other one I know is true. There is supposition that with a FFEL loan, you could see an increase in the amount of interest that you're paying and perhaps larger payments down the road because of that. Frankly, I don't understand how that would happen, because when you consolidate, typically the only way that your interest rate changes is that it might be rounded up, but that should be a relatively minor change in the amount of interest that you're paying. So I will confess, I am unclear about how people are saying that you could see increases in your interest rate or your payment as a result of consolidation. With Perkins loans, I can see that there would be potential disadvantages to consolidating those. Perkins loans have even more protections for borrowers than other federal loans. And I'm not going to go into the details of that, but go to studentaid.gov and look up the protections, the features of Perkins loans that make them so valuable, and which of those you might lose if you consolidate into another federal loan that is not a Perkins loan. That one I can see where it might not be to your advantage to do. And finally, maybe you're one of the fortunate folks who, not fortunate in that you have a student loan, but fortunate in that your income has not been impacted at this point. You are still making around the same amount of money that you were before. You still have the ability to make payments toward your student loan. In that case, you may want to go ahead and make voluntary payments, particularly if you are in the standard repayment plan where you are going to repay every dollar of that loan. Voluntary payments right now will be applied 100% toward principal, and it will help you pay down the loans much more quickly by doing that. Leaving the federal loans and the special arrangements that the CARES Act put into place and talking about private loans for a moment, or a federal loan that doesn't qualify and that you're not going to consolidate. On April 21st, which is just last week, but it feels like a month ago, Governor Pritzker announced an agreement that Illinois and I believe it's 8 other states together have worked out with 20 of the largest loan servicers of private loans and federal loans not paid directly to the federal government. And they have arranged for certain types of relief under these loans. It may take the form of a forbearance of up to 90 days. It may be waiver of late fees. There could be other features that are available. And the instructions that were in the news release that came out from the governor's office last week said that borrowers should contact their loan servicers. Oh, that's a typo. I keep meaning to catch that. That should say servicers, not services, to identify what options may be available to you. All right, so that's student loans. Again, if you have questions about that, please go ahead and place those in the chat. And we will talk briefly here about income taxes. This is the most straightforward part of the whole thing. Early on, most of us already had heard that April 15th was no longer the filing deadline for taxes this year, not for federal and not for state. For both Illinois and your federal, you do not have to file until July 15th, and you do not have to pay until July 15th. And there was no paperwork required to get that. It was automatic. There would be no interest or penalties accumulating if you do owe money and need to pay on the 15th. Now, one caveat on that. If the amount that you owe would have put you in penalty territory anyway, if you had filed on April 15th, I believe that those penalties will still be in place, but there will be no other penalties, no additional penalties for paying late on July 15th. This applies to basically any federal return, individual returns, estate returns, trust returns, all of those. And for federal, it also includes any estimated tax payments that you would have been making for 2020 up to this point. Both payment one that was due April 15th and payment 2, which isn't normally due until June 15th. Those are both being delayed for federal income taxes until July 15th. Not Illinois. You see the footnote on here. Illinois did not give relief about their estimated tax payments. And so if you haven't made the first one, and you should have, you are now late. Please hurry and go do that. And be sure you make the second one by June 15th. This also, just through a backdoor thing, happened to also extend the amount of time you have to file a 2016 return if you didn't file and you should have received a refund, or to amend that 2016 return if you should have been getting additional refund based on something that you missed or something that wasn't done correctly on your return. And if you were planning to contribute yet to an IRA or a health savings account for last year, for 2019, you will still have until July 15th to make those contributions as well. The fact that you can delay until July 15th filing your taxes doesn't necessarily mean that it's a good thing. If you're due a refund, why not go ahead and file and get it now? But please, if you can, file electronically, not by paper, so that you will be able to get that refund more quickly. And if you do pay estimated taxes, but you're going to take advantage of the fact that the federal government isn't making you pay them yet, here's a suggestion. And this is actually true for your estimated taxes. It's also true if you're going to owe when you file your taxes. And if you already had money set aside for that, please protect that money, earmark it, move it into a separate savings account, hide it in a cookie jar. I don't really care what you do to segregate it out so that you protect that and don't let it be too easy for you to use that money for other things, so that when July 15 comes, you still have those dollars to pay your income tax and to pay those estimated taxes. Okay, any questions about income taxes that I didn't mention? Again, please put those into the chat. And now we're going to run through some more general ideas about how to get through this very uncertain time. Some of you may already be experiencing financial difficulty. You may be among those 30 million people that have already lost jobs, or you may be worried about what's coming. In either case, there may be something here to help you. First thing, when times are uncertain, cash is king. When we don't know what's coming, we don't know whether our job is stable, we don't know whether our hours will be the same, we don't know if the cost of food is going to go up, having cash on hand for any type of emergency is always something that puts you in a much stronger position. With cash, there aren't any strings. It's not like it's dictated that it has to go for this or for that. You can use it how you need to. But again, to protect this emergency fund, just like what I said with the money, if you already have it for your taxes, segregate it from your regular money for paying the bills this month. Put it somewhere so that you know this money is for emergencies, and you won't inadvertently or just by temptation end up using it for other things. Why cash is so important? Let's say that you have lost your job, or your hours were cut. Let's say your hours were cut. You're working 50%. You're going to get some unemployment, but let's say you're still going to be in the hole compared to usual $500 a month. Let's say that this goes on for 6 months. 6 months, you're in the hole $500 a month. That means that you're either using savings or going into debt $3,000. If you went into debt for that $3,000, especially if it was on a credit card, even worse as a cash advance, even worse as a payday loan or a title loan, that $3,000 of income that you missed, you might end up in a situation where it's going to cost you $4,000 or $5,000 or $6,000 in order to get out of that hole. On the other hand, if you had cash on hand, if you had an emergency fund of that size, you would come out at the end having depleted your savings, but having only used $3,000, not having such a big hole to dig yourself out of. And the reason, another reason that I'm focusing on cash here is based on what we saw in 2008, 2009. I knew several individuals who had credit card debt. They had been diligently working to pay down their debt, and they kept doing that even through the recession. Their thinking was, instead of keeping cash, they were paying down their debt to save the interest that would have been adding up on there, and counting on the fact that they would have a credit line to draw on when they needed it. What happened was in 2008, 2009, many banks cut the credit lines on their credit cards, even as the cardholders were paying down debt and proving how creditworthy they were. Because of the economy, these banks were cutting those credit lines. This is one of the reasons why in uncertain times like we are right now, cash really is king. This is the only time you'll probably ever hear me say, you might want to consider making minimum payments on your credit cards right now if you don't have an emergency fund already, so that you can preserve as much cash as possible. I also suggest that even if you have not yet been impacted, that you have a plan of how you would reduce spending if needed. It means that if you do find yourself in a situation where income has dropped or expenses have increased, you're going to be able to deal with it better. We're able to make better decisions when we're proactive, when we're planning ahead, instead of making decisions when we're already under duress, when things have already become traumatic, when we're already worried about the money for the groceries next week. But the other thing it allows you to do is to react more quickly as well as wisely when the situation arises that you do need to reduce your spending. And by the way, if you haven't been impacted, your income is still stable and where it was, there's no reason why you might not still choose to go ahead and make this plan and implement it so that you could, again, build up that cash reserve, putting yourself in a better position in case of a worst case scenario. If your income drops, if you're typical, according to research, it will take you 6 months to adjust to that reduced income. And again, think about the example I gave of where if your income drops and you're going in the hole $500 a month, how deep that hole could become very quickly. If you're someone who could adapt faster, even without an emergency fund, you might be able to minimize that. And instead of finding yourself $3,000 in debt at the end, maybe it's only $2,000, maybe it's only $1,000. How much easier will it be to come back if you owe less, if the hole you've dug yourself into is less? And this is, again, why I think having that plan is so important, so that if you need to reduce expenses, you can do, you know how you're going to do it already. You can take action quickly and don't waste this time of figuring it out after the situation is already changing. And if you find yourself in a situation where you can't pay everything, then you're going to need to prioritize. And I will tell you also that your priority should be those things that look after you and your family's safety and well-being, and not whoever holds the debt that is calling you 3 times a day, harassing you. That may be a payment that, yes, you owe the money, but other things may be more important. And here's an example. Let's say you have 2 debts. One is your car payment, and another is your credit card. You can't pay both. You're trying to decide what to do. Here's one thing you usually don't do. Don't send part to both of them, because then you'll be behind on both and in bad graces with both. Typically, it's better to pay something in full. You're trying to decide which one. Well, ask yourself, what happens if I don't pay this? What happens if I don't make my car payment? Well, before very long, that car is going to get repossessed. Do you need that car to get to your work? Are you going to lose your job if you don't have the car? On the other hand, what happens if I don't pay the credit card? Yes, there'll be a late fee. Yes, there's going to be additional interest. Yes, they're going to report me as late on my credit history. But weigh that against the loss of your car. Which one has a worse impact on you and your family? And another way to make things go further is to look for non-cash resources that you can use instead of your money. Why do you think we're seeing such long lines at food banks right now? It's because if they can get food at a food bank, it means that the limited cash they have can then be used for other things. And one example of existing types of government programs that we have, not just because of COVID-19, but that are there all the time, are our food stamp program here in the state, that's known as SNAP. And we have other forms of assistance as well. You'll find more information about that on my webpage. If you can't pay, call. Thinking back to that example where you decide perhaps that making the car payment is what you really have to do and you really can't make the credit card payment, or at least not paying what's due, call them ASAP. You don't have to wait until you're late. You don't even have to wait until the due date. Calculate how much you think you can pay. Maybe the bill, maybe you'd normally be paying $75. You can't do that, but you think you could do $20 a month. Call, ask them to work with you. Maybe they will waive late fees. Maybe they will waive interest, or maybe they'll reduce the interest rate or reduce the payments for a time. Maybe they'll suspend payments for a while. You don't know until you ask. But once you've worked out an agreement with them, do whatever it takes to follow through, so that if something bad happens to you again later on, they may be willing to work with you again. But if you negotiate with them and you don't follow through, they may become very intransigent and not willing to cooperate with you after that. If money is an issue, you might be thinking about two things that the law put into place, making it easier to raid your 401k and your IRA. The CARES Act says that you can borrow more from your 401k now than usually. And there'll be a delayed start to when you'd have to make those payments back into your 401k. There are at least two issues with that. One is that if you borrow the money, and especially with the delayed time for repaying, that is time that the money in your account that you've taken out can no longer grow to better cover your needs in retirement. And so it's not just that you took money out and had to pay it back with interest. You may have lost significant returns during that time. You might have seen significant growth in the account had you not taken it out. Secondly, what if you don't keep the job? You only have a very limited amount of time after you leave a job to pay back any loan to your 401k before it becomes taxable income, perhaps even with early distribution penalty, 10%, typically if you're under age 59 and a half. So there are potential downsides here. There may be times when this is your last resort and you're going to take it, but evaluate the potential problems you might run into. The second way that they made it easier to take money out of not only your 401k, but your IRA, 403b, and so forth, this is called a coronavirus-related distribution, and that's actually being abbreviated as CRD. They're going to let you take money out of these accounts and put it back in. It's not a loan. You're not going to pay it back with interest. It's going to be treated like a rollover. You may be familiar with how if you have money in an employer plan or in an IRA and you want to move it over to another account, to another IRA or another employer plan, you do a rollover where the money moves and there's no tax consequences. What they're really doing here is they're letting you take a distribution, but you can make it be a rollover if you're able to put the money back in within 3 years. If you do put it back in, there would be no taxes, no early distribution penalty. It's unclear at this point, though, how you report this on your income taxes. And I will tell you that in a discussion forum that I lurk in, I do not prepare taxes for clients, but I teach about taxes, obviously, and I hang out with tax preparers so that I can hear what they're talking about. And I've heard some of them speculating how much more complicated this could make a tax return, not just for 1 year, but up to 3 years. And if you pay someone to prepare your taxes, that's going to be an indirect cost of this distribution as well. Just something to think about. So think of these as a last resort. Ask yourself what will happen if you're unable to replace the money. Ask yourself how secure your job is, whether it's likely that you will be around to pay back that loan. And then the last thing I'll say is a really negative thought. It's really looking at a worst case scenario, but I feel obligated to mention this. Retirement accounts like 401ks and IRAs are protected assets when it comes to creditors. How they're protected differs. The 401k is protected by federal law, the IRA is protected by state law, and so it's not quite equal. But in both cases, there are protections to keep creditors from being able to take these accounts. That includes bankruptcy. If you did down the road end up in bankruptcy because of what started here during the pandemic, and you still had an IRA or you still had a 401k, odds are that you will be allowed to keep those assets because they are protected from creditors. On the other hand, if you use them and are not able, if you take money out of these accounts and you're not able to put it back in, and you still end up in bankruptcy down the road, you will actually be in worse shape after the bankruptcy than if you had left these accounts alone and had them protected for you in the end. And finally, I guess this is a love-hate relationship. It's kind of fun to talk about scammers. It's also really scary to talk about scammers. But scammers definitely love situations like what we're in right now, where there's so much uncertainty, so much fear. We're worried, we're exhausted. Those are times that make us more vulnerable. And because there is so much that's unknown about this virus, that also makes us vulnerable, trying to distinguish what's truth from truth from fallacy. So remember, if it sounds too good to be true, it probably is. And so I want you to remember, whenever someone is claiming something, they're telling you they're from the IRS and they're going to help you get your payment, but they just need $50. Or they're from your bank and there's a problem getting your economic impact payment, and they need all of your information about your account in order to help you get that money deposited. Whoa, let's take a step back and figure out, how can we verify what these folks are saying? If it's a phone call, ask them for a call, ask them what a number is where you can call them back, ask them for the name of the person you're talking to, then hang up, look up what you know to be a true contact number for either of those two organizations and call them and say, are you trying to reach me about this? And I will tell you for sure, if it's the IRS, they'll say no if you can get through to them. IRS does not call you. They communicate by mail, and that's about it. If you're hearing things about, oh, this is a secret, we have found the cure for COVID-19, or we know about secret programs that can get you money that the government doesn't want you to know about. If those are phone calls, hang up. If you're on social media and you're seeing this, just stop reading. If you're on Facebook or another platform that allows you to report scams, do that. I actually reported an advertisement on Facebook last week for the first time. I've been on Facebook 10 years. There was an ad last week. It actually wasn't a scam, but it was wrong. It was inaccurate. And I discovered, I didn't know it before, but I discovered that there was a place I could click. It's the same place you click to say, I don't want to see any more ads like this. There's also a way there to say, I want to report this ad because it's either inappropriate, it's a scam, or what have you. So try to protect yourself. Junk mail probably isn't the main way scammers are going to try to get at you in this time and age, but it's always possible. So be wary of phone calls from numbers you don't recognize. Be wary of junk mail that's always pre-sorted standard pay rate. Anything that doesn't pass the smell test, be very, very careful. In a time like this, the last thing you want to do is to use up your limited financial resources on something that turns out to be a falsehood. Okay, I want to remind you that everything we talked about tonight is included on a web page that I set up just a few weeks ago, obviously, when this all started happening, on my website. And in case you have any difficulty getting there, here's how to go find it. In your search engine, type KarenChanFinancialEd.com. That should take you to my website. Once there, like every other website, it has tabs. Click on the tab for COVID-19 and your finances, and you will find a long page with all of this information. There's like a table of contents where you can click on the topic that you want to know about and jump to that section of the page to get exactly what you want. And literally everything that we've talked about today will be on there. So that concludes the planned part of our presentation. And so I'm going to first, I'm going to again thank Patty and Schaumburg Township District Library for bringing this to you guys tonight. But I'm going to ask Patty to come back and help me, because I have not been monitoring chat while I've been talking, and let Patty tell me what questions we have that I can try to answer for you tonight.
And I am back. Hello, Karen.
Hey there.
Thank you so very much. What a comprehensive program. You covered a great deal of territory. And I really appreciate you noting the scammers.
Yes, they're
as
out there.
Well. You know, I think that we've all been home. Many of us have been home, you know, working from home, if at all possible, for these past weeks. And I have received so many attempts of calls on my cell. The volume has just been annoyingly high. And I think that, you know, preying on individuals, like you said, in a vulnerable time, and also knowing that a number of people might just be very lonely for someone to talk to.
There you
So
go.
let's talk about our vehicles. Let's talk about our savings account. Let's talk about things, and at the same time, it makes us really loosen up and offer up information that's very easy for them to take. So we do have to remain guarded, and I'm glad that that was the wrap up of your presentation.
Thanks for the feedback.
We have two questions. One of them was from me, and so I'm just going to put mine on the back seat from now.
Okay.
And the other one is from another attendee. It says, "Hi, Karen. According to Terry Savage's column, bond mutual funds for holding savings are undesirable at this certain time. I'm retired for 3 years. Any thoughts? Thank you."
Okay. We'll have to, I have to, for everybody else who's listening, I want to back up for a moment and just talk about bonds in general for a second. Bonds are generally viewed as the investment that you put money into for stability, historically for income, but nowadays, to be honest, we look at them more for stability compared to stocks, where we expect and do see these days huge fluctuations sometimes in the value. Long-term bonds in particular do change value based on changes in interest rate and expectations about changes in interest rate. Short-term bonds, less so. Short-term bonds have historically been quite stable. But in today's environment, bonds in general are paying low interest rates. And there is some risk, two kinds of risk. Well, more than that, but right now, I think we're mainly concerned with the fact that the value of bonds is perhaps less stable now than it has typically been in the past. And now, if it's government bonds, you generally expect to be paid back, but corporate bonds depend on the ability of those corporations to make the payments, to pay the interest, and to pay the principal back. In economic times like this, we don't know which corporations are going to weather the storm and which ones won't. Now, you can look up ratings for them, which ones are most financially stable and which ones aren't. But I can understand Terry Savage saying that right now, bonds may not be the safest haven that we usually have thought of them. And so you might instead look to actual cash investments, and these aren't investments, actually, they're savings vehicles. You might be looking at CDs. You might be searching out some of the higher interest savings accounts. There are no high interest savings accounts nowadays. But whereas, I'll give you an example. The bank that I have my checking account at, the savings account pays a whopping 0.01% interest. It is nothing. What it does is it preserves my principal, but it gives me nothing beyond that. But if you look around, you can find financially secure banks that are covered by FDIC insurance or NCUA, which is the credit union equivalent. where you might get at this point 1.5%. You know, it's not still not huge, but it beats the heck out of 0.01. So I'm not here to give investment advice, but I guess I would just say this. I'm not sure anyone who has been in bonds needs to sell all of them and get out into cash, but you might want to look at shifting more toward cash. And if you do have a fair amount of investments, I would be looking to your professional financial advisor to help you with that. Preferably someone who is a registered investment advisor, meaning that they have a legal responsibility to be a fiduciary for you, rather than someone who would look for an opportunity to make money by churning your account. That's kind of a long answer. Did I help? If the person has a follow-up that I didn't answer completely that question, you're welcome to post again in the chat.
Okay, the next comment, and it's not a question, is a compliment, and it's from one of our attendees that says, "Thank you, Karen. You're such a dynamic presenter. The information was thorough. I really like the flow chart presented. Thanks, Schaumburg Library, for hosting."
I am so thrilled somebody liked the flow chart.
That is wonderfully, wonderfully received. And the patron that had asked that other question to your about the mutual funds came back and said, "Perfect, you are the best."
Okay, cool.
So, well, this is very nice. This is I love this chat box here. Okay, my question,
yes,
is you have talked about cash and talked about emergency funds. So I think I just want a clear understanding. What do you think is a reasonable amount of cash on hand? And when you say on hand, I assume that to be in the house, not necessarily in my wallet, but in the house. And then then how much to keep in an account? And is this different than an emergency fund? All
right. Let me first clarify what my definition of emergency fund is, and it does not really mean cash in the house. It probably should include some cash in the house, but your emergency fund could be in an insured savings account at a bank. It could be in a short-term CD. If you have a substantial emergency fund, it could be in a series of CDs with rolling maturity dates. It should not be in long-term bonds. It shouldn't be in stocks by any means, or mutual funds that invest in either of those things. The definition of emergency fund is that it's money that you could get your hands on quickly without sacrificing value. Okay, now how much? The goal is for those of us, and I'm like half in the working world and half in the retirement world, so I kind of identify with both. For folks who are still in their working years, whose main concern typically is what we're seeing right now, loss of income because of job loss. The goal is to have enough money to cover 6 months of expenses. That doesn't really mean equal to 6 months of your income, because part of your income goes to taxes, 401k contributions, so on and so forth. So the goal is enough to cover 6 months of expenses. The thing is, you don't get there overnight. You get there the same way you eat an elephant, which, in case you didn't know, the answer is you eat an elephant one bite at a time. So you get there by putting money into a savings account or into a hidden place in your home or whatever, $25 at a time, $5 at a time. Once you've got $50 or $100, your goal becomes the next $50 or the next $100. And so here's what I'm trying to say is, don't hear the idea that you should have 6 months of expenses in your emergency fund. Like I said, that's a goal. Get as close to that as you can. Don't worry about that you aren't there. Just do something. For retirees, it's a little different. And I actually almost got into an argument with somebody last week. She's a recent retiree. I think she's worried about losses in their investments. Apparently they have some investments, because she was talking about how much they had, the percentage of loss that people had seen. And she was talking about a 6 month emergency fund. And I was like, hold on, that's the guideline for people who are working and worried about loss of income. When you are approaching retirement or in retirement, your situation is you're worried about the amount of expenses you have that are not covered by guaranteed income, that are not covered by Social Security, or if you're lucky, a pension. In other words, the money that you have to be pulling out of savings every month to cover the rest of your expenses. Sort of, well, different people use different numbers, but a fairly typical recommendation would be a retiree needs enough money, not in stocks and not in bonds, but in cash or maybe short-term bonds, to cover 2 years worth of expenses that are not covered by Social Security or pension. That can be a sizable amount of money. The goal is that when we encounter a time like this, that you don't have to sell your long-term bonds at a loss, or you don't have to sell your mutual fund with stocks in it at a loss because you need the money for expenses. You're trying to avoid putting yourself in that position. And Patty, you did ask an interesting part there about the cash at home. You know, I don't think people have really thought too much about keeping cash at home. Since 2000, we were all afraid we weren't going to be able to get money out of the ATMs when the Y2K happened. And so we were building up cash at home. We are not worried about banks failing. I don't think we're worried about ATMs not working. But in a time when you're trying not to go out and you really don't want to make extra trips to the bank, I think this is actually a good time to keep a little bit of cash at home, a little bit more than you might have otherwise, assuming that you're not someone who will spend it just because it's there. I will not tell my sister to keep cash at home because it will be spent. So you have to know yourself.
Excellent answers. Thank you so much. Do any of our other attendees have any further questions for Karen? Okay. Well, Karen, once again, thank you so much on behalf of the Schaumburg Library. We really appreciate you returning above and beyond Money Smart Week and to be one of our first presenters on an online platform. I'm beginning to see that this is our future as a radio show. I certainly won't be I'll just be the producer. But
it's actually very effective. And in my previous life with University of Illinois Extension, when we only had a couple of educators in personal finance and we were trying to serve the entire state of Illinois, we did a lot of what we called then distance learning, and now it's just turned into webinars and virtual events. But it has been and it remains an effective way to get hold of people. So I really appreciate the folks who were game to give this a try tonight and came. And Patty, I think you mentioned this early, but maybe some other folks, some people weren't on, that you are recording this and it is going to be posted if they know other people who might want to take a listen.
Yes, actually, we're very pleased. So the difficulties we were dealing with in the beginning part of the presentation were corrected by our department director. Behind the scenes, she was able to work some magic remotely, and we have been live streaming on YouTube since the first couple of minutes that we had to stall. So it is on there now, and it will be on there until decisions are, we'll take a look at it at the end of May and see if this information, as you had mentioned earlier, was still current and relatable, or if new information had come out and then we need to revisit it.
Right.
But otherwise, yes, we are up and running, and it is there as an archive.
Cool.
An active archive.
Great.
So, all right, to all of our attendees, just know that your library really appreciates you, your support. While our structure isn't open, we are open for questions. You are certainly welcome to get in touch with us online, and we will respond to you as soon as possible. We are doing as much as we can. Our online resources are there for you, and there are people behind the scenes. We're just not able to work under the same building right now. But we can't wait until we are able to connect with our community in that way again. Please do take care of all of yourselves. And Karen, thank you again for everything. And I look forward to partnering with you in the near future, maybe before the end of the year this fall.
Sounds great. Take care.
Right. You too. Thank you. So long.
Good night, everybody.